If you have spent any time in crypto, you have probably heard the term paper Bitcoin being thrown around. But what does it actually mean, and why should it matter to you as an investor? Paper Bitcoin refers to any investment that gives indirect exposure to Bitcoin without actually holding the underlying asset. This includes futures contracts, ETFs, exchange balances, and wrapped tokens. Many have alleged that there is significantly more paper Bitcoin in existence than real BTC actually backing it. And critics argue that this paper market exerts an outsized influence on Bitcoin's price, similar to how derivatives dominate and distort pricing in the gold market. Today on Web3 Verse, Alex is breaking down exactly what paper Bitcoin is, how it has shaped BTC's price, and what the controversies surrounding it really mean for the market going forward. Let's get into it. To understand paper Bitcoin, it helps to first understand paper assets more broadly. A paper asset is any investment that gives you exposure to something without you directly owning that thing. Gold is the classic example. Most gold trading globally happens through futures contracts, options, ETFs, and unallocated accounts. The overwhelming majority of people trading gold have never touched a physical bar in their lives. They hold paper contracts representing exposure to gold's price. Paper Bitcoin works the same way. Futures contracts, options, derivatives-based ETFs, and exchange balances all allow investors to gain exposure to Bitcoin's price without ever controlling actual BTC on-chain. Technically, paper Bitcoin in its institutional form has existed since December 2017 when the Chicago Mercantile Exchange launched regulated Bitcoin futures for the first time. That launch marked the first moment institutional investors could trade BTC price exposure on a regulated exchange. Notably, that launch coincided almost exactly with the peak of the 2017 bull market. Whether that timing was purely coincidental is a question the market still debates. But paper Bitcoin in a broader sense goes back to Bitcoin's earliest exchange days. Mt. Gox, which once handled roughly 80% of all global Bitcoin trades, collapsed in 2014 after losing hundreds of thousands of BTC through hacks, mismanagement, and accounting failures. Customers who had trusted the exchange with their funds were left holding paper balances, essentially worthless IOUs. Multiple other exchanges suffered similar fates through hacks and insolvencies over the years. In every case, the common thread was the same. Customer balances were recorded on exchange ledgers, but the actual BTC was not there to back them. Paper Bitcoin today manifests across 5 distinct categories, each with its own characteristics and risks. The largest category is crypto exchanges, which collectively hold an estimated 15% of Bitcoin's total supply. Exchanges are the most historically controversial paper Bitcoin issuer given the sector's long history of hacks, mismanagement, and outright fraud. Following the collapse of FTX, which infamously used customer funds for its own trading, investments, and even political donations, exchanges began implementing proof of reserves to provide on-chain evidence that they actually hold the crypto they claim to. While proof of reserves has its limitations, it represents a meaningful step toward transparency. The second largest category is spot Bitcoin ETFs, which collectively hold nearly 1.6 million BTC, roughly 7% of total supply. These products allow investors to gain regulated Bitcoin exposure through a standard brokerage account without managing private keys or on-chain complexity. The issue is that spot ETF issuers have not publicly disclosed their Bitcoin wallet addresses, making independent verification of their holdings difficult. Third-party analytics firms have identified some wallets, but official disclosure remains absent. Bitcoin treasury companies represent the third category, collectively holding around 1.1 million BTC or approximately 5% of total supply. When investors buy shares in companies like Strategy, the world's largest Bitcoin treasury company, they are betting on the company's performance rather than owning Bitcoin directly. Most treasury companies have not disclosed their wallet addresses either, which has fueled persistent skepticism about whether all declared holdings are verifiable. Governments constitute the fourth category. Nation-states collectively hold an estimated 646,000 BTC through seizures, mining operations, and strategic reserve policies. The United States leads with approximately 328,000 BTC, followed by China and the United Kingdom. Again, most governments have not publicly disclosed wallet addresses, making their holdings largely unverifiable through on-chain analysis alone. The fifth category is wrapped Bitcoin and DeFi, tokens like WBTC that are supposedly backed one-to-one by real BTC and used across decentralized finance protocols for borrowing, lending, and yield generation. Wrapped Bitcoin protocols collectively hold over 380,000 BTC. Unlike most other paper Bitcoin categories, Wrapped Bitcoin protocols generally do provide proof of reserves, making verification more accessible. However, the redemption process is not always guaranteed and custodial risks still apply. So how has paper Bitcoin actually impacted BTC's price over the years? The overall impact has been significantly positive, primarily because paper Bitcoin has made BTC accessible to vastly more capital than could have reached it otherwise. Exchanges built the infrastructure that transformed Bitcoin from a niche peer-to-peer asset into a globally traded market. Without them, Bitcoin trading would be illiquid, fragmented, and largely inaccessible to most investors. CME futures legitimized Bitcoin as an institutional asset class worthy of serious capital allocation. Strategy's initial $250 million Bitcoin purchase in 2020 became the catalyst that inspired hundreds of other companies to add BTC to their balance sheets, each purchase reinforcing Bitcoin's credibility as a store of value. And spot Bitcoin ETFs, which launched in early 2024, were arguably the single most bullish paper Bitcoin development in history, directly instrumental in driving BTC to its all-time high. The relationship between ETF flows and price is now direct and observable. Heavy ETF inflows push prices up. Heavy outflows push prices down. When sustained net outflows began in late 2024, Bitcoin's price decline followed closely. Paper Bitcoin has also generated significant controversy, with allegations centering on whether declared holdings are genuine. Strategy has been the primary target of these allegations. Despite holding over 700,000 BTC, the company has repeatedly declined to provide proof of reserves, citing security concerns and fears that wallet movements could spook markets. Critics have alleged that Strategy may be holding Bitcoin derivatives rather than actual BTC, or that its holdings have been rehypothecated, meaning the same BTC used as collateral multiple times, creating multiple paper claims on a single underlying asset. Strategy's CEO publicly responded by asserting the company buys real Bitcoin, audits its custodians, and does not rehypothecate. Third-party on-chain analysis has tracked a significant portion of Strategy's holdings across multiple wallets, though at least 110,000 BTC remain unaccounted for through public on-chain analysis. Spot Bitcoin ETFs faced similar scrutiny before and after launch, with questions about whether custodians truly held the underlying BTC. Independent analysts provided reassurance, and third-party tracking has since identified holdings consistent with declared figures, though official wallet disclosure has never been provided. Coinbase has also faced allegations of selling paper Bitcoin to institutional clients like BlackRock, which its CEO directly denied during a public question-and-answer session. The custodial risk concern is not merely theoretical. History has demonstrated repeatedly that exchanges and custodians can be compromised. A major custodian hack today, at a scale consistent with current institutional holdings, could trigger market chaos far exceeding anything seen in Bitcoin's earlier years. Looking forward, paper Bitcoin's role in the crypto ecosystem is only going to expand. Institutional infrastructure is significantly more robust today than during Bitcoin's early exchange era. ETFs are driving both adoption and price discovery at a scale retail investors alone could never achieve. And in a significant development, the SEC approved the ability for spot Bitcoin ETF shareholders to exchange their paper shares directly for the physical Bitcoin backing them, a mechanism that could serve as a template for reforming other paper asset markets including gold. The ideal scenario for Bitcoin's long-term health remains widespread self-custody. True ownership of private keys embodies the original ethos of Bitcoin: financial sovereignty, censorship resistance, and elimination of counterparty risk. The barrier to achieving that has dropped considerably as wallet technology becomes more user-friendly and accessible. For those not yet ready to take that step, understanding exactly what form of paper Bitcoin you are holding, who is custodying it, and what verification exists for those holdings is the minimum due diligence every investor should be performing. Paper Bitcoin built the market Bitcoin operates in today. Understanding it is essential to navigating what comes next. That is everything for today on Web3 Verse. Drop your thoughts in the comments and we will see you in the next one.